What, how long would you like me to get started for too?
Like an hour or so.
Perfect. Okay.
So guys, I'll pretend, not pretend, present to you one of the big guys out in real life trading US. He is the father of credit spreads, and not only a great trader but also a great person. I've had the pleasure of talking to him and with him several times on these, on Zoom, but also when we met at the advanced retreat here a month or two ago. It was awesome. And Tony has a special story that I'll bet you'll hear today. That every time I hear it, I've heard it a few times. My hair just, and I realize I don't have much of it. It's just blown back of the tenacity and the sheer willpower of wanting to make this work. What I've asked Tony to talk to us about today is, of course, his trader story, but also the pitfalls and the things to be aware of with the credit spread strategy. And then, of course, your view, Tony, on the whole S-curve thing. That I know you have a nickname in the real trading community of knife hands, or was it Teflon hands, because you managed to put the buy order in where everyone else have their stop loss. So with these words, Tony, the floor is yours. And guys, if there's any questions, put it in the chat as usual, and Henrik and I will make sure that Tony gets them as appropriate.
Sounds great. Thank you so much for having me. Thank you for that kind of introduction. I love it. Can you hear me okay? I want to make sure that's good before I get started.
I hear you loud and clear. Is there anyone who's got issues with the sound? I'll just try this in Danish. Er der nogen, som ikke kan høre noget? All right. Seems to me like we're all good.
Okay, fantastic. Let's roll. So, as was mentioned, my name is Tony. I have been a full-time trader for quite a few years now. Let's get into my story a little bit. With this story, before I get started, I want to give a little bit of background into, I'll give you the end. I'll give you the secret sauce at the start, and I'll show you my story. And I want you to pay attention to how that secret sauce of success played out and with me. Okay. When it comes to the markets, things can either happen to you or they can happen for you. The markets are going to beat you up. They are going to stretch you. They are going to push you. You're going to be challenged in ways that you've never been challenged before. And again, your perception of that is what's going to help you succeed and change your life dramatically. Because trading is simply a skill. It has really no IQ or knowledge, I guess you should say smarts, doesn't really play that much into it. What really separates those from being successful and not are the ones that believe they can do it, and the ones that don't are the ones that aren't successful are simply the ones that quit. Okay. If you stick with this long enough and you ride out the hard times, you will see the sunlight. Most people can't make it through night to see the sunrise in the morning, because the markets are really going to, as soon as you feel like you've got it, they're going to knock you down. And then when you're down, they're going to kick you once again. Right. So going into that, if you can view it as, I just want to learn, I want to grow in my knowledge as much as humanly possible. And one of the greatest ways to learn is through failing. If you can change your definition on what failing means, I like to call it abundantly failing. What does that mean? It means that I go from, it's the shift of mentality to, I'm going to lose all of my money, to, if I lose all of my money, I will have learned so much through that experience that I can go out and find more money somewhere. And with this new knowledge, make 10 times more than I lost. And that's the difference. Things either happen to you or they happen for you. I think too many people are quick to define themselves. I am this, I am a loser, I am a failure. You're not. Failing and being a failure are completely different things, okay? So with that being said, remember, learn from these things. View them as learning opportunities. Be more excited to trade after a loss and follow the plan than you were before, because through this loss, you have now gained a knowledge nugget. You now have something that you can lean on to make you better the next time you trade. You are now a better trader than you were a day ago because of whatever hard thing happened in the market. And it's all about that shift in perspective that's going to make all the difference in the world. So let me tell you my story. My story is I was just a truck driver. I drove a semi truck for years and years and years. I ran a business doing that. And I was tired of working. I worked 7 days a week, anywhere from 60 to 80 hours a week. And I had no life. I've always dabbled in the markets. I've always loved the markets. And I felt prompted from God to say, you know what, quit this, move to Utah. I was living in Arizona at the time, move to Utah and start trading. And so I was like, let's do it. So we sold everything that we had. We moved to Utah. We bought a house. And we're like, all right, well, I got $30,000 trading account and I'm going to be a millionaire in 3 weeks, right? That was the expectation. I felt like this was the universe calling me to this. The universe is going to make it work. And within the first month, I had pretty much lost almost everything. And it was not what I had planned on doing, right? It was not the plan. So we had some money in savings. I took that money out of savings. I put it into my trading account and I was like, let's go. Okay. Again, you'll notice a common theme. I didn't define myself as a loser after I blew up $30,000 in a month. I was more excited to trade with the new knowledge that I had now. Got some more money, and that lasted me, I think, a month and a half, and I lost all that money. And I turned around and said, okay, well, I'm all out of my money. Let's go to the bank. So I had really good credit, so I went and took a loan out, got that money in there. That money lasted me about a month. Went back to the bank, took another loan out. That money lasted me a couple months. I think at this point, I'm like 6 to 7 months in, and I'm gone through 2 loans. And I walk back in after losing that money. And I'm more excited to trade than ever because I have so much more knowledge of how to make money. Okay, I know what not to do now. Let's see if I can figure this out. And I was day trading this entire time. So I was day trading, trying to figure out how to do this. I was day trading options and just couldn't quite make it where I didn't know exactly how to be. My skills weren't up to par to do what I wanted to do yet. I thought they were, but they weren't. And on top of that, my emotions weren't there. Like when you have to make $5,000 at the end of the week, or at the end of the month, it's a whole different story compared to just taking some trades, right? So it was a battle. It was tough. I go back to the bank and the bank's like, I know this guy. Like this guy, dude, go get a job, go do something because I can't give you any more money. Like who comes back to the bank after all of these months with all these loans, right? And I convinced them to give me a couple credit cards. At this point, I knew this was it. So I either go get another job to build up money to try trading again, or I make this work. And so instead of just trading, I was like, there's got to be another way to do this. I knew about credit spreads, but I knew credit spreads I had 15,000 in my account. That's what I had on those credit cards. So I knew that credit spreads would work. I liked the idea of credit spreads. They have a really high win rate. They're very consistent. But I could make like $300 to $500 a month with that size an account. I'm like, how can I make $1,500 a week? So then I started getting busy. I start thinking, I start back trading, I start planning this out for about a week or two. And I came up with a strategy where it was possible that I could possibly make $1,500 a week with a $15,000 account, which is insane. And so I'm like, you know, I got nothing else to lose. Let's give this a shot. And that first week I made 1,500. Oh my gosh. The second week made 1,500. The third week made 1,500. The fourth week made 2,000. And it just, all of a sudden I'm paying my bills. I'm like, this is amazing. Right. And I still had a lot of lessons to learn, because as I was paying my bills and trying to get ahead, I would do something that you're not supposed to do with credit spreads. I would screw up a hedge. I would sell against a strong trend. I would just do every mistake in the book. And we'll go over those mistakes here. And I kept losing. And I'm like, dang it. Okay, well, I'd lose on that. And I'd work about a week and I'd make up that money. And then I'd do something else and lose on that. Work about a week or two to make up that money. And I would just keep going that route. Right. And so it started to build, and I started having something. And I'm like, wow, this is crazy. And after about a year and a half of consistently making about 10 to 15% of my account each week, I knew we were here. In the meantime, I started to grow in my knowledge of day trading and all these other things just that took time to gain. And I started to incorporate a lot of these other things. And so that was my story of how I made it. I then acquired some more capital, went some other ways, and the rest is history. I jumped on with RLT about a year and a half later, and I've been teaching others this strategy that pulled me out of the hole. And I've been doing that now for years and years and years with RLT. So that's kind of my specialty. That's what I do for a living. I sell credit spreads to pay my bills, and I still day trade and swing trade and do all that other fun stuff. But credit spreads, even to this day, that same exact strategy is still my number one way of paying my bills each and every week, each and every month as a full-time trader. So that's a little bit about my story. And I wanted to give you that secret sauce at the start so that you could roll that back in and see the difference. I think most people in my situation, after the second time they've lost everything, would have allowed ego, would have allowed a new definition of themselves. Like, I'm just a failure. I can't do this. And the only reason I made it when others don't is because I simply didn't quit. I got up and I found a way. And every single time I'm like, I'm done. There's no more. I can't make any more money. I'm all out of money. I have this new knowledge now. I would get up, quit whining, start thinking. And within 30 minutes, I would find a way to make more money. I'd find a way to get some more money, and kept going. And I stuck in the game long enough to where it finally clicked. I got it and started changing my life and making a living trading. I think that's the reason why most people struggle in the markets, is because they just don't have that attitude of sticking around. They define themselves. I lost all of my money. I've done this. It's not working out the way it's supposed to. And then they quit.
So,
and
Tony,
instead of learning from it, they'd fail. What's that,
Tony,
Peter?
how do you control your emotions? I think you and I talked about this when we met at the retreat. You know, all the emotions that go through you when you lose and keep losing and get kicked around all the time. So we've been talking, you know, it's no secret that we've had a hard 2022 so far, right? Because it's been very choppy going down. We've tried a number of things, and the suck just keeps coming. We keep on getting kicked around, right? And every time we think we have a winner, you know, it'll go a day or two, and then all of a sudden we'll be stopped out. Yeah. So how do you control that?
Man, that's a great question. And I've been right in there with you. So this year in January through February, I had 22 winners in a row on spreads. And since March 15th until now, I've had 3 losses in a row. And so honestly, to me, it's pretty normal. I think once or twice a year, you have these months where nothing really works, right? All your swing trades are getting stopped out. Credit spreads are kind of getting whipsawed, and it's normally during the chop. And so last year it was November. I went 8 months without a loss, and then November hit, and I think I lost on 4 in a row. That's just kind of how it goes, right? That's the story behind it. That's kind of how the thing is played. So, yeah, to get over those emotions, it's really hard. Number one, you've got to love yourself. You got to love yourself and have confidence that you can do it without any external things giving you that confidence. And that sounds weird and it sounds hard, but it's the truth. I had no experience of success in the markets. So why was I so confident in myself when I first started to stick with it? Because I knew I could do it. If someone else has done it, it's possible to do it again. And I knew that people were successful in the markets, and I knew I could be, right? So number one thing, you've got to make sure that you don't allow your results to change your definition and love of yourself. If you've lost on 3 credit spreads in a row and you start to go, oh, I'm just not a good trader, something must be wrong, it's time to go to a new strategy, it's time to do this, it's all this external stuff is changing who you currently are, right? What was the difference between me crushing it and me sucking? I mean, really, it was just the knowledge I needed to grow. And how do you gain that knowledge? It's through making mistakes, it's through losses, it's through failures, and you come back stronger with more knowledge, more prepared to be better the next time around, right? And so that's step number 1, love yourself. Don't allow any external thing to come in to change your definition of who you are. You're able to do this. If you've lost on 55 credit spreads in a row, it does not matter. You're simply still needing to learn that one thing that's going to turn the corner and start making you profits. That's it. Step number 2, accept the loss. Too many people are so scared to lose money that they lose money. What you focus on expands. So if you're focused on, I am so scared I'm going to lose money, I can't lose money, I can't lose on one more credit spread, I can't do this, that's exactly what's going to happen. You have to change your mentality and realize how the game is played. The strategy doesn't have a 100% win rate. It's got 90%. Well, it's like, well, that's cool, Tony, but I just started last month. Well, unfortunately, you started on the month where people were taking their 10% of losses, right? So you've got to stick around long enough to get your 90% of the wins. And as your knowledge grows, so does your ability to lessen your losses, but not only that, extend your winners. So for me, when some of my students were losing in March, I didn't take those losses because I knew when to stay out. I told them, they were like, nah, it's good, I'm still going to take all these trades. And that's okay. That's totally fine. And those trades started to reverse. And that was right when the markets just went straight crazy, straight up for the next, 3 weeks, right? And so for us, it's about accepting the loss, right? Don't allow money to control you. You control yourself, control your money. If you understand the risk of the trade and you are completely fine losing that money, you'll let the trade work. And most of the time people lose money is because they do not allow the trade to work. They try to put a hedge on before the alert level. They think, oh, that's a big bear candle and it's not looking good, so I'll just take my $100 win. And then it reverses 3 days later and you would have made your profits, right? It's normally people getting in the way of simply not following it. And what's the root cause behind that? Well, again, number 1, they're basing their self-worth off of how much money they make. I don't want to be a loser on this because then everyone knows I'm a loser, or I don't want to lose money because my spouse will be mad at me. So their definition of themselves, right? Does your spouse love you because you make them money? If that's the only reason, that's not a great relationship, right? So you've got to redefine those, but also accept the loss. Understand how the game is played. Understand that we're going to have crazy times in the market. When the markets act weird, that's when I normally lose. How often does that happen? Once or twice a year. And that's about when I have my losses. And so in this session, also, I'll show you exactly what I look for on the S curves. A few things that I've been doing lately that have been working extremely well in these crazy markets, because you have to continue to adapt. The markets are not the same markets that they were 2 years ago, right? They have these little changes. The strategy still works just fine. But in times where the markets are a lot more choppy, we might get a lot more of this year. I've been able to adjust. And again, it's the same strategy. It's just using a different time frame. And that's all the adjustment needed to start making some money again. So that's basically the story behind controlling your emotions, is accept the loss. If you are too scared to lose that money, you're trading with too much money. You need to lower your size. And then ask yourself, are you putting too much weight on this win or loss, right? Does it really matter? Over 100 trades, does this one trade have any significance? No, it doesn't. It's not going to make or break you. And if it is, you're putting way too much size on it. And so most of the time, the emotions come from the ego of I've got to win or I can't lose. And the second part of that is tying into just accept the loss. If you can answer both of those questions of nothing relies on this outcome of this trade, emotionally and financially, then who cares if you lose? And then once you stop caring about winning or losing, guess what starts happening? You start winning. The trades start working. And that's a big part of being successful and overcoming those emotions. It's not easy. but with practice and answering a few of those questions every day. So I have my students write in a journal every day. It's not like Dear Diary, it's got a few questions, right? What are you basing your self-worth on today? Did you accept the loss today? Did your emotions change your trading plan today? Right? And they're going through and they're taking a recap of yesterday. And in the mornings before they trade, they're answering questions that put them into a good headspace. Are there things outside of trading that are causing stress in your life? Et cetera, et cetera, et cetera, right? To make sure that you're in the peak state of trading. That peak state of trading is going to come from that abundance mentality, right? That abundantly failing. If I do lose, I'm excited because I'm going to gain more knowledge and I'll be a better trader tomorrow than I am today. Instead of, oh, I'm going to lose all this money, look at it as I'm going to learn a lot of lessons. And those lessons, the knowledge is what makes money, right? So answering a few of those questions, monitoring your emotions, and then working on it takes practice. And over the years, you get better and better and better. But really, if you just decide, I'm not going to quit, I'm going to become a better person, I'm going to control my emotions better, I'm going to be more patient, I'm going to love myself besides the results, good or bad, it doesn't matter. I can do this, I will learn, I'll be better. You'll succeed. And that's really the secret to it.
Cool deal, man. That's powerful. Especially in times like these where as I said, we've been kicked around a bit. So it's nice to know that someone else has been through that, and also that there is light at the end of the tunnel. So should we go on and talk about credit spreads and particularly the pitfalls and do's and do nots that you have identified? Because I taught your strategy 2 or 3 weeks ago, and followed it to the dot. So people know the strategy, or most people here know your strategy. We are starting to gain some experience, but as you just said, we've been through some choppy times, and I think many of us are like your students, that we did take those trades at the bottom just when it turned, and again in the top a week and a half ago when it turned the other way around also. So we got double whammy right there. So
yeah, for sure. The pitfalls, for sure. I would say selling against the trend. I'm going to help you walk through what the trend definition is here in just a second. Sell with the trend. Don't try to call tops. Don't try to call bottoms. Meaning, if it's bearish, and I'll show you exactly what the definition of that. If you're bearish, then don't sell bull put spreads trying to call a bounce. If it's bullish, don't try to call the top by saying, well, it's 10 bull candles in a row, it's going to go lower, right? Those usually lead to losses. So that's pitfall number one to stay away from. Stay with the trend. If there's 10 bull candles in a row, cool. Wait for a pullback and sell a bull put spread because clearly it's strong, right? So stay with the trend. Another one is keep your spread together. Meaning you have a sold put and a long put, or a sold call and a long call. You have 2 strikes. Those are protected as long as you're together. As soon as you unravel it, so meaning, all right, well, the spread is losing. So if I get out of my short strike and I take a $10,000 loss on that, but I'm up $8,000 on my long strike, and if it continues to move in my direction, then I could be up $15,000 and make $3,000 on this win. That's something I hardly ever do. And if I do it, it has very defined risk, but I recommend never doing it. I completely blew up $20,000 in one trade. And this is another pitfall that ties into this. When I was starting out learning how to trade credit spreads, I think I was doing it for like 5 months or so afterwards, very successfully. Let's see, I was losing on Amazon. Okay. And I was like, well, okay, Amazon looks very, very bearish. And my max loss was $5,000. Okay. I was only down $1,000. And I was like, man, I can't lose this $1,000. Right. Again, ego, a lot of that other stuff. Can't lose this $5,000. I was living and dying on one trade when it doesn't really matter. So what I did was I was like, well, if I unravel this, and Amazon just moves $2 down, I can make $4 grand. What I didn't realize is if I unravel it and Amazon moves $2 up, I'm going to lose 15,000. So I unravel it, and meaning I get out of one leg. So I get out of the short leg, right? I still have my long put, and I just need the price to go down a couple bucks. It was right then when the price shot through the roof and went up, I think like $5 on Amazon, which can happen as $3,000 stock. And I got out as fast as I could, looked at my broker, and I was down, like I said, it was well over $15,000. I can't remember the exact amount, but it was just under 20, just above 15. So somewhere in that. And I go, Tony, you had a $5,000 max loss. And because you didn't want to take that loss, you ended up losing $19,000. It starts to kind of change a little bit, right? You're thinking of, don't blow up and turn something into a massive loss to try to save a little bit of money. So with credit spreads, you're always risking more than you're making, but you have a very high win rate. So it makes sense. So if you could just do your best to lose small, that would be my next little thing here, is just recap of all that. Don't turn a loser into a massive loser. Just take the loss. It's okay to lose 30% of your max loss, right? So if you did one contract, you're going to lose 150 bucks. Take it. The next little, again, side note into this is a lot of people go, okay, well, I'm losing on this spread, but if it just bounces, it should bounce. It's had 10 bear candles in a row. It should bounce, then I can win. Here's the problem with that thinking. It works with shares because this is basically a 50-50 proposition. If it reverses, I'll win. If it doesn't, I lose. So if you have a 50-50 chance, right? Flipping heads or tails on a coin, it needs the payout, the reward versus the risk has to be favorable for you in order for that to work. But credit spreads, it's not. If it reverses, you'll make a couple $100 win on the credit spread. If it doesn't, you lose a couple $1,000. And so it doesn't make any sense to say, well, I know I'm losing on this spread, but instead of getting out at break even, I'm going to hold on and see if this wins. Doesn't work, because you could win on 3 of them, but the one time it doesn't, it undoes all of that times 5, right? So that would be another pitfall I would say avoid, is if it's not working, that's where the concern zone comes in. If you get that daily close in your concern zone, I am trying to get out at break even. That's it. Or I would play the hedge plan if the hedge alert goes off.
I'll just let's just piggyback on that one, because it's been one of my personal things with some of the trades I've done is, should I get out as soon as you get into the alert zone, or I translated it into days, so I can't.
The concern zone. Yeah.
Concern zone. Yeah. Sorry.
Yeah.
Should just turn it off as soon as we close into that zone, or should I wait until it gets to the alert zone and start hedging and these things? What's your thought? Is it just terminate it when it gets in the concern zone?
So if we get a daily close in that concern zone, for me, if I am close to break even or profitable, I get out. If I'm not, so meaning I'm more than 5% of my max loss away from it. So if I'm risking $500 and I'm down more than $50 or down more than $25, whatever, right? Then I'm gonna hold on to it. I'm not gonna get out yet. I'm gonna wait for it to be within that threshold. Because theta's taking time of taking value off of that option. If it can hang out in my concern zone for a few days, or maybe even it bounces, once I get around break even, I get out then. If I'm not profitable when it closes in my concern zone, I just leave it. I do nothing, but I go ahead and put an order in to get out around break even, right? I'm not going to try to make money on this anymore. And then I just play out my hedge plan. So if I'll have my hedge plan go through, we go off and we play that guy in rock and roll. So that's how I manage those. Is once I get my concern zone, I don't get out unless I'm at break even or profitable. If I'm not, I just wait until I am, or follow the hedge plan and hedge it.
All right, cool. Well, that's great. we have had some issues with the hedges also. I think most of the issues has been that we've been in too early, start hedging too early, and then it bounces and we lose on both. That's pretty annoying.
Yeah.
See, I've got a few questions here, so I'm thinking whether we should do the questions now or wait till you have spoken through S curves, because that might answer some of the questions. So I think we'll do that. So just go ahead, talk about your S curves. I'm very interested in that. I was really blown aback when we talked about it at the retreat, and then we could go through the specific questions we have. Most of them are regarding credit spreads, which is the overall whole topic anyway. So why don't we go ahead and do that?
Let's dive in. Do you mind if I share my screen?
Oh, go ahead. Go ahead.
Awesome. Can you see my chart?
Yes, we are. We can.
Good. All right. So what I want to do is I want to help you answer the question of, are we bullish or are we bearish? Okay. Because credit spreads are amazing, but if you keep selling bull put spreads when the market's bearish, you're gonna get crushed. When you sell bear call spreads when the markets are bullish, you'll get crushed. And so you've got to know which direction the markets are moving. And so the markets move with S curves. Okay. So we have a move up, that's step one. Step two is a move down, and step three is a move back up. That's a bullish S curve. So the market moves like this, right? And we'll pull up some charts here in just a second. This is exactly what a market moves like for a bull market. Okay. So for a bull market here on this S curve, we are simply looking at the closest higher low. That's it. Once we get below this higher low, we are no longer bullish. All right. So if we come all the way down to here, are we still bullish? Yes, we are still bullish. And if it gets all the way back up to here, I have a new higher low, right? It's higher than that one. So it's my new higher low. If it comes down to here and does this, I have a new higher low. So the bulls are bullish until we get below that with a close, okay? So it doesn't matter about these anymore. It's always the closest one. So if the market comes down and closes below this, we have now broken the bull trend. This bull trend is over with. Now we are focused on this bear trend. How does a bear trend move? See if I can get this going. There we go. A bear trend does the exact same thing, just flipped upside down. Okay. So a bear trend moves like this: part one, part two, part three. So it's more like this. This is how a bear trend moves. And on a bear trend, we're looking at the lower highs. We don't care about this. We care about this, the lower high, the closest lower high. Okay. So as it bounces up and comes down again, that's our closest lower high. So I don't care about this one anymore. I care about this one. The bulls are trying to break this. The bears are trying to keep it below that, right? So as we continue to bounce, that would break this bear trend. And now it's time for another bull trend. So the bulls are down here. That's the tipping point, right? Because we don't have any other higher lows. Comes here, and then the bulls repeat the process until the higher low is broken. And then the bears repeat the process. Does that make sense? We're doing okay on that so far?
Very much. It's very much in line with what I taught. Funny enough,
Good.
because that's what you taught me.
Yep, there we go. So I'll go over a few of those rules here, and then I'll show you how that applies onto a chart, okay? And I'll show you how you could have been making money all month long in March, and so far this month in April, okay? So for me, I need, and Peter, let me know, you may have already taught this with the two opposite candles and then getting back up to the high. So for a bull S curve, this is not a higher low yet. It has to get back up at least to the spot that it pulled back from. Once it gets back up to there, it doesn't matter if it closes up here or anything, as long as it just gets up there, this is now your higher low. So this is not a higher low yet. My low is still down here. Okay. So this is my low still. Once this gets up to here, then that's my higher low. Okay. Same thing on the bear side. It has to get back down to where it bounced before this is a lower high. So if it does this, this is not a lower high yet. And by the way, this works on every single time frame. You can do it on a weekly, on a daily, on a 3-minute, on a 30-second. It doesn't matter. Every time frame, you're going to see S curves. Okay. So with that being said, one last rule, it needs to have at least 2 candles of the opposite direction, meaning if we come up to here and it starts to pull back, I need at least 2 bear candles in this pullback before it goes higher. They don't have to be back to back. There could be a different candle in between here, but as long as there's at least 2 on the way down. And in a bear move, there needs to be at least 2 bull candles on the way up. Okay. And then a move back down. That's how we determine the higher low and the lower high. Those are my rules that help keep me out of whipsaw stuff. Okay. So now let's dive in to an hourly chart, and I want to show you how you could be making money this entire past month. So if we dive into this here, and we're on the SPY, and by the way, on these hourly charts, I'm looking at selling probably 2-week spreads or so. You can do weekly spreads also, but normally 2-week spreads. All right. So if we come across here, here we go. I'm trying to remember exactly how and why this thing is. I'm on a 1 hour, right? Yeah.
And you see this obviously without extended hours on.
Yeah, it's easier without extended hours on. Yeah. Yep. So right here, I'm trying to figure out exactly where I want to start at. So if we come around on this guy here, we are bearish, correct? We are, I'll draw out this S curve for you. We got move there, up, down, right? I'm still waiting on 2 bull candles. It's up. This is chopping around, but I needed to come back down to this low here before I consider this a lower high there, correct? So we come up, we come back down, and we get back to that low. Perfect. So now I have a lower high here. It bounces up with 2 bull candles here. All right, move this a little bit. I have 2 bull candles, and then we get back down to this low. So now I have a lower high here. Okay. So the bulls break above this guy. So this is a level the bears can't give up. The bulls break up above it. And so they close above this guy. So this is no longer bearish. We'll practice this a lot more. This is no longer bearish. We're bullish now. So at what point do the bulls have to hold? They have to hold this low because they've just gone straight up now, right? So are we still bullish? Yes. Are we still bullish? Yes. Are we still bullish? Yes. We still haven't quite closed below that. So we've been bullish this entire time. On this bounce now, we get right here, we get 2 bear candles right there and then a bounce. So now I have a higher low that the bulls have to hold. So let me I'll put this so it's easier to see. There we go. All right. So we have this happening here, right? We have a higher low here. This is 2 candles. It's a little bit hard to see. So what does this mean? It means the bulls have to hold this. So we are bullish. We've got a direction. So I'm looking to sell bull put spreads. The next question is what should happen next? Well, remember the S curve. And then the next spot is this. And so if I'm looking at this guy and I see this S curve, what's the next phase? A move down and then a bounce back up, right? So I am waiting for a move down, and then I'm going to sell a bull put spread down below that higher low. If you can get a second higher low, that's even better. So I would try to sell a bull put spread down below 416 on a pullback. Okay. So there's your pullback. It looks scary, but you got to ask yourself the question, are we bullish or are we bearish? We are bullish until we get below this higher low, correct? So we sell a bull put spread down here. All you have to do is be correct for 1 day. Boom. You win the very next day. So there's your win. What do we have here now? We have a new higher low. So we had a higher low here. We had a new higher low here. So there's one winning credit spread. And what I want this to do is continue to push and then come back down and bounce. We're just drawing out the S curve, right? So now let's see what happens. See if we get a push. There's our push. Perfect. Now I want this to come back down, still pushing. I'm still waiting for it to come back down, still waiting. And then it decided to rampage, right? So for me, even this is actually a bear candle. And it pushed down, and now we have a new S curve. So for me now, in order for me to sell a bull put spread on a pullback to here, it would have to break the higher low. So now the trend is over with, right? Because you have to wait for the second opposite candle close before you can open your spread. Yes, I want the S curve to be complete. And so I want the opposite candles to come in here, and then I want it to do this. And then I'm going to wait for a pullback on that. Does that make sense? So like right now, I have an S curve here and a new higher low. So this was my higher low earlier. I was hoping for a pullback. I never got it. It just kept going. And then I got a little baby pullback with 2 bear candles. That's all I need. And then we got back up to this high. Okay. So I have a new higher low here. So now I can't do a credit spread down here, because if we come down, that means we're no longer bullish. I'd be looking for a bear call spread up here, right? So now what I want to see is a push down and a bounce up. Okay. So let's see if I get that push down. I need a little bit more of a push down. There we go. There's my push down right there. And so I'm going to sell a credit spread below this. So setup 1 will be at the higher low. On these hourly ones, I recommend you give yourself this two S curves. So probably back down to this S curve here is where I'd look to sell that. And it's the exact same plan, right? Selling it at the higher low would be setup 1. Selling it down below it would be setup 2. Or if you wanted to use this S curve, setup 1 will be there and setup 2 would be down here, using that as an alert level, correct? So I sell a credit spread and let's see what happens. So it's still not quite bouncing yet, not quite bouncing. There we go. It bounced after a couple days. That's all you'd need. You win. So you're already out of that one, right? So now we have a new higher low, right? Multiple bear candles. And then we got back up to that high. So now this is my new higher low. So on this guy here, you could do another one if you want. To me, this is kind of starting to get a little bit late in the move, but still doable. You could keep going until you have to hedge, which is totally fine. You should be able to get it out about 10 winners in or so. So let's go ahead and say we had this pullback, right? You have this S curve, and now this would be the pullback. So we could sell another credit spread probably down there. And remember, we win as long as it stays above it. And since we're selling 2-week spreads, really, you just need it to move up for 2 days and you win. That's pretty much all you need. If it goes sideways, you probably need to go sideways for about 4 days. If it starts moving down, then it's going to need to get back up above the spot that you got in after about a week for you to win. Okay. So remember, we sold that spread. That would be close, but let's keep going for a few more days and see if we can win on this. There we go. Boom. Another win. So what do we have here now? 2 bear candles and a move up. You starting to get the picture? We're just playing the S curve, my friends. Enter a spread. Enter a spread. And every time we enter a spread and win, it makes a new higher low. Cool, right? So on this one, what should happen next? What's the next part of the spread? Push back down and then a bounce. That's what should happen. Eventually, this trend is going to break. Trends don't just go on forever, right? So eventually, instead of doing this, it's going to do this. And that's when we would have to hedge, right? But if you can win on 10 credit spreads and lose on 1 even without the hedge, you're still really profitable, right? You're still doing, you're doing okay. So
do you use Elliott wave to figure out whether we are approaching a top so that you wouldn't start a new credit spread? Yeah.
Totally. Yeah, you could use Elliott wave. You can use support and resistance. Just knowing we're coming into a very strong resistance here, it's probably not the best idea to get in on a retest here, right? But that's why it's so crucial to have a really strong hedge plan, because if we get below this, are we bullish anymore? If we close below that, no. So we're bearish. What should happen? Should move down. So if I can sell a spread here and use that as my alert level at the higher low, I can be buying puts and riding that thing down. I'd be in it for 1 day or so on the hedge. And rock and roll, we offset our loss and get ready for the next one. And now we know, guess what? Now we know we're bearish. So once we hedge our spread, we can wait for a retest back up. sell a bear call up above that, and let it roll back down. We win, right? And we just keep playing the game until the trend changes. And so here's 4 credit spreads that we could have won on just in the month of March, right? And so let's see if we get a pullback. We can do another one. Honestly, in this case, I would probably pass on this one, especially on that gap. So boom, there we go. All right, so now we have what? We have a new higher low, multiple bear candles pulling back, and then we got back up to that high. Make sense? There's our higher low. So I can't sell a credit spread here anymore, because if it gets down to my entry, that means we've broken the bull trend. I don't want to sell a bull put spread when we're bearish, all right? Staying with the trend. Remember, that's one of my rules. Stay with the trend. Makes it a heck of a lot easier. So for me, I don't want to sell a credit spread unless it makes a perfect S curve. Meaning it needs to not just get back up to the spot. It needs to put in quite a few candles past it. At least 2 to 3 is what I like to see. So if I see a stock that does this, that's not a pullback I want to get in on. I only get on pullbacks that look like this. They're breaking through with multiple candles above that first pullback right here, right? See the difference? We should have done that. Instead, we did this, right? So in this situation, if we pulled back here, do I want to sell a bull put spread on that? No. I want multiple candles higher and then a pullback. Then I could sell a spread if you chose to, right? In this case, I would most likely avoid all the spreads up into here, because I'm guessing that a trend is starting to change, right? You got the RSI really up high, overbought. You're into a resistance. You do a wave count on this, you're probably pushing that wave 5 by now. It just makes sense, right? So let's wait and see what happens. So like, again, on that pullback, I'm not selling a spread on right here. Not doing it. I need this to rampage higher before it pulls back. Just like this one did, right? We pulled up, we rampaged, and then we pulled back. It clearly got up above that by multiple candles, right? We clearly got above this resistance by multiple candles. That's the trick. Make sure you're letting it move quite a few candles above this resistance. You don't want that. You want that. Now you get in on a pullback, okay? So on this one, I'm not selling a credit spread on. And boom, we got a close below the higher low, right? So we are what? No longer bullish. This entire bull move is over with, and now we're bearish. So now the bears have to hold this. For me, normally, I won't just sell a bear call spread on that initial push up. I'm going to wait for it to give me what? A perfect S curve. Meaning I want it to get back down below this bouncing spot with multiple candles, and then on a retest, I'll get in. Okay. So I got multiple candles. Right now, I'm going to wait for a retest back up and sell a spread up above that. Will it pull back? I have no idea. Eventually it will. There we go. Here's our pullback right here. Boom. Sell a bear call spread with 2 weeks out, using probably that as my alert level and up there, right? What should a bear S curve do? Should it roll back down? If it continues to go higher, are we still bearish? Yes, we are bearish until we close above that high right there. Okay. So I'm selling a bear call spread on that. And boom, we win. What did it just do? We now have a new lower high, correct? We bounced up with multiple bull candles now, and then we made it all the way back down to this low. Perfect. So now what am I looking at doing? Wait for a bounce, sell another bear call spread using that as my lower high. All right. So let's wait for a bounce right there. It's probably about good enough, because I'm guessing normally it's going to come into that low, and that's pretty much what that did. So that would be the bounce I'd be looking for. My alert would have gone off. I would have put an alert on that right there. It bounces, alert goes off. I'm selling a bear call up here using that as my alert level. And ooh, went even higher. So right now we'd be down, but it doesn't really matter, because if it can just hang out for a few days, you win. There we go. Boom, you win, because it's had about 2 days of theta eat it up. So we have a new what? We have a new lower high. Do you see how the S curve is how the markets work? And you can apply this to day trading, swing trading, credit spread, whatever you want. Once you can answer the question, are we bullish or bearish? And then what should happen next? You can make a lot of money.
Hey, Tony, could you just for the sake of all the guys who's not started credit spread yet, but who'd like to apply this for their swing or day trade, try and set a trade up using your S curve like you just did as a normal stocks swing or day.
Great point. So right here, we're going to ask ourselves the question of what should happen next. We should get a bounce up and a roll down, right? So I know the bears are wrong up here. So that's where your stop needs to go. So your stop needs to go above this point. Your target for me normally goes down to where we're currently at. So that'd be my 1R target, which would put my entry somewhere in between. Probably my entry goes right there. So this is exactly how I do this with shares. I'd wait for a bounce. Have we missed it? No, still waiting for a bounce. It's still in the part 1 of the S curve. There's the bounce. Oh, we may have missed it now. Yeah, it just barely didn't fill me. But that's exactly how I would do it with shares. Is I would be waiting for that S curve bounce, right?
So you would actually find your stop loss and your target before you find out where you want to get in, which is kind of opposite of what Jeremy would teach, right?
Yeah. So for me, I already know the equation, right? I know that my stop, like in this instance right here on this next setup, my stop has to be above this, correct? Like that's the lower high. So my stop needs to go above that. My target 1 is where it's currently at. So if the next hour continues to go lower, I can move my target down lower. But once it gets to that, now I can just move my entry to where this says 1R. There's my 1R target right there. Boom. As you can see, I actually did do this trade. I did it with puts. So on this, where it bounced back up here, boom, right there, we got filled right there. What should happen next? Should roll down, right? Let this thing, it went up a little bit higher and it went to target. Boom. That was a trade we just did. You could have done it with shares. You could do it with a credit spread, whatever you want to be doing, right? So that's kind of an example of how to do this. So again, next question on this, remember, we should do what? We should easily put multiple candles below this bouncing spot, right? Am I looking to get in on a bounce right here? No, because it stopped there. We need it to continue down, right? I want the S curve to do that, not this. What does this look like? Double bottom. Double bottom is simply when an S curve doesn't continue and reverses. That's a double bottom. What does a double top look like? Right there. That's simply an S curve that should have gone higher that didn't, and then reversed and broke the trend. Right? Makes sense? So we're watching this and it goes lower. So what do I need? A couple candles lower. Starts to bounce right back up above it. So I only got 1 candle close below this pivot and then it starts to bounce. And I'm like, okay, well, we'll see. And then it starts to bounce again. I'm like, okay, well, I'm guessing we're going to make 1 more roll down, but this is not doing what I want it to do, right? All the other ones, we broke it and continued lower with at least two candles past it, right? So let's see what happens. We get another one and then it bounces again. You see how we're just not going lower? It did that and then it did that and then it did that. And it just cannot go lower. That's a sign of weakness for the bears. The bears should do this easily. We got the heck out. And then just the other day, right? What do we have right here? 2 bull candles and then a retest with that little wick right here. We have a lower high, my friends. Lower high. So is this bear trend still there or is it broken? It's broken. We are now bullish. This bear trend is over with. And again, if we do a wave count on this, we've got 1, 2, 3, 4, 5. A, B, C. Back up, right? So the wave count totally applies there. How crazy is that? So now we are bullish. What should happen now? Move up, down, and then back up. Following the S curve, my friends. We are live now. This is where we're looking at. So fast forward this. We're expecting a pullback, and boom, we got 2 bear candles and a bounce. So there's my higher low. I wanted a pullback down to here, and I would have sold bull put spreads down here. I didn't get it. So what do I want to see? I want to see multiple bull candles up here. And if I get this pullback, I'll sell some credit spreads using probably that as my alert and sell them down here somewhere. Right? So I haven't really looked here. There we go. So we've gotten multiple candles up above this, which is great. And now we're pulling back. Again, the bulls have to hold this level. So what is it time to do right now? Time to sell a bull put spread. Is there a chance that the bulls fail this and it reverses and goes bearish with us being in a bull put spread? Of course. That's called a channel. That's the chop. That's the garbage that we're in right now on a daily chart. We are what's called a chop. We are just going sideways. That's why the hourly time frame, this is the, by the way, my friends, what I just showed you is exactly what I do on a daily chart. It's just the problem with the daily chart is I have no levels, right? So we are bearish over here, bounce, go down, there's my lower high, bounce. Didn't quite make a lower high here because we never made it back down to that. So I can't count any of these as my lower highs. So currently my lower high is right here. We got to close up above it. So this bear move is over with. Now we're bullish. So now the bulls have to hold this. The bulls went up, 2 bear candles down, but we never made it back up to that high, right? So this is not a higher low. So in my opinion, on the markets, on a daily, we are still bullish. You see how we could be bearish on an hourly, but still overall bullish on a daily? So what are we trying to do right now on a daily? We're trying to do this. We'll see if that comes in. I have no idea. Is there a chance that we just continue to chop? If we break this, are we still bullish? Yeah, we're still bullish until we break that. So if it comes down, I'm still bullish on everything. So that's the reason why I haven't done too many monthly spreads, is because I don't have, my closest higher low is all the way down here. And I can't necessarily get paid on anything like that. So I have been doing a couple iron condors. I'm in one right now, making me some money. But in the meantime, I'm just hanging out. I'm just waiting, right? So until I get this, which will give me a new higher low that I could now trade off of, right? Sell a spread down here and get a bounce. Or until I get this, breaking that. I can't really do very many monthly spreads right now, right? So I've had to adjust. And I'm doing the exact same thing, exact same strategy. It's just on a smaller time frame. It's on an hourly time frame. That's it.
So Tony,
so right now is the time to get into a bull put spread.
In the course, Tony, you mentioned that you only do weeklies on 6 specific stocks.
Yep.
Does that still apply, or have you changed that?
It does.
Also?
Yep. So on these, I'm doing 2 weeks credit spread. So I can do a 2 week on any credit on any stock. Yep. So if I'm looking right now on this guy and I go out 2 weeks on the SPX, even though this is the SPY, I always sell it on the SPX because it pays more money. So that would be the 29th, end of the month, 29th. Does this pay me anything? So I'll show you exactly what I'm trying to set up right now in real time. I want to sell below this. I want to sell below 435. So if I go to the SPX, you notice they'll look exactly the same. I want to sell below 430, 43.70. Okay. So if I look at the premium, I still need to get paid 10% and all that good jazz. I can easily get paid that. So I can get paid 43.10 still pays me something. So I could sell it all the way down here. So I want to get a couple percentage down. So 43.10 would be a little bit small for this guy. On this, with this strategy, I don't mind it not being 2% because it's on an hourly time frame. So I'm just waiting on I'm waiting on an hourly candle close, and then I'm just going to day trade that down. Basically, we can kind of go into that later on. So as long as it's enough of a room for me to actually, anything over 1%, 1.5% is kind of ideal. So yeah, 43.10 would be perfect. So I could look to sell the 43.10. It pays 60 cents. That is 14%. It's 15% now, right? And so we could put that into our broker and say, all right, well, this is what I want to sell. It pays 650 bucks. And if I'm wrong and the markets don't bounce here and it comes all the way down and breaks this with an hourly close, my friends, right? That's reversing and we're going to head lower, right? Correct? So on this guy here, we have a higher low sitting right there. So if we get below this guy, we would break this bull trend. And that would tell me that we're simply in a chop. So whenever the bears get stopped out, so again, the bears got stopped out here and now we're bullish. And if the bulls immediately get stopped out, so back to back really quickly, that tells me we're just in a channel. And I wait until we get above that or below this to really determine a trend again. That makes sense. So there's a good chance that that happens and we continue to go lower. There's a very good chance that that's possible. We look at the Qs. So the Qs have already broken their bull trend, right? Let's see here. Oh, actually, no, they never got back down to this low right here. So we're still bearish on all of this and it never actually got a close above that. So we are actually still bearish on the Qs until we get a close above that. So, but on the SPY, we are. The SPY on that wick right here made it all the way down to this low. And there we go. So on this guy, if I look at my analysis chart on him, if we hang out until the 23rd, so actually the 22nd, which would be Friday, if we go up to, I need to go to the SPX. If we go up to 45.20, boom, that's target by Friday. So again, it takes a couple days, moving up 2 to 3 days, and you're ready to rock and roll. There's $600 in 2 days. So that's exactly how I've been playing these. You need to be a little bit more. Here's this Epiphany City. I love it. Awesome, man. Do I ever use a stop loss on the plan? I don't. I'm at my computer, and if I get an hourly, in this situation, if I get an hourly candle close below my sold strike, then I close it out. I set my spreads up though where I can hedge them. All right, this is a clear, easy level. We break this, we're going down. Right? So it's an easy place for me to be able to buy puts. And those puts will make me more money than this spread can lose. And then I can just get out of everything for break even or a small win. And that's kind of the game plan. That's the idea behind it. And again, is this a higher low right here? Multiple bear candles and then we never quite made it back up to that high. So in my opinion, no, the higher low is still right here. Right? So this is in the middle of earnings season, which might cause more gaps across the market. If you want to hold off for a few weeks and let earnings season pass, then it's up to you. It all depends on how aggressive you want to be and how confident you are in hedging. And for me on a hedge, what I'm doing is I'm just simply saying, all right, well, if I sold the 43.20, which I'm looking to do, and this is my alert level. If we break this, I just need to use my analysis tool to be able to calculate how many puts do I need to buy to make enough money to offset this. So if I look at this and say, okay, I'll be down $300 on my spread down here. So I need these puts that I'm going to buy up here to make $300 in that move. And you can use the analysis tool. Peter can show you how to do that. And it's on my masterclass to kind of walk you through exactly how many you need. You can use the analysis chart to be able to determine, okay, if I buy one put, I'll only make $150 down here. Well, my spread's going to be down $300. So I need to buy 2 puts. And that will make my $300 and offset how much my spread is losing. Right? That's all the calculations you're doing. And you're just using levels to be able to tell you what should and shouldn't happen.
It's cool. Awesome, Tony. Thank you very much. That's you know, as you can see on the comments, I think I got like 90% of your S curves right. I think it was the wait for the next dip bit that I might not have gotten, but we certainly get it now.
Yeah.
So I don't know. I'll just run through the questions that people have written here, and then we'll see. Let's see. Mogens asked about trend and S-curve. I think we've got that down. Benjamin asks about time frames, and you just went through that very clearly. And Jacob asks, how many stocks do you typically trade weekly spreads on? Or how many weekly spreads do you typically have open at a time?
Oh, okay. I usually, on these 2-week spreads, I try not to have more than 2 or 3 open, and I don't want them to all look exactly the same.
Right. So not AMD and NVIDIA at the same time.
Exactly. Yep.
Right.
Because then you're just hedging 2 that are moving in the same direction. You want them to be different. So I could have like Wells Fargo open. Remember, these are all 2-week spreads, not weeklies. I can do my weeklies on these. That's how I've always done them on an hourly chart. But most of these are 2-week spreads. And that allows me to be able to sell far enough away, so that I can actually get paid something, but I also have a good hedge plan.
Yeah.
Right. And this is a credit spread again that I'm looking at doing on the SPX, and I'm going to use the SPY to hedge this. So I'd probably buy like the 435 strike puts on SPY if we need to, buy enough puts on SPY to be able to hedge that guy and then be able to get out. So, yeah.
In the course you write, and that's especially on your 1-week spreads, that you only trade these on Mondays and Tuesdays.
Yeah.
But when you do bi-weeklies, you do them on all days. Is that correct?
On all days. Yep. Totally. So like on this one right now, I'm going to try to get filled at 0.6. And yeah, so yeah, we'll see what happens with that guy, but I'm going to try to get into this spread at 43.20. And so it doesn't have to be on a Monday or Tuesday for these 2-week spreads. I just don't want it to be that current week. So if it's Thursday, you can still do next Friday.
Yeah.
It just can't be in the same week that you're in currently right now.
That is so cool. That is so cool. I think especially the credit spread people got, as Henrik writes, an epiphany. But I'd say we could use this for our day and swing trades as well. We've been, typically in my by twice a week stock analysis, I do tend to see if I can find your good S-curve entries, but this has certainly sharpened that edge a little. So hopefully I'll apply this in the future.
I love it, man.
So guys, please do write any other questions in the chat pane. As you see, Tony is reading them as well. And when you write in English, he'll actually be able to understand it as well.
Yeah. So this was awesome. You always see the replay in slow motion.
Yeah. Of course, the recording of this will go on YouTube as usual, but also on the course. So this will be the add-on for the credit spread course on the page as well. And I do know that I owe you guys a promo link, and you'll get it very soon.
Awesome.
Cool. Tony, hey, thank you very much for coming. This has been so great. I thought I had S-curves and credit spreads down, but there's always a little detail here, a little detail there that you can get sharper on. And I think in particular, what you said about, the choppiness of the market right now just does not call for the weekly, for the monthly spreads, so that we should go to the shorter time frame, which is basically also what Jeremy says regarding swing trading and day trading, right? That when swing trading sucks, revert back to day trading because it's less choppy.
Yeah, exactly.
Cool. Well, hey, thank you very much for coming. Guys, okay, Henrik has a final question here. Did you ever consider using the 78-minute chart to have any, you can read it.
You totally can. It's up to you to kind of find your niche, go back and back trade it. Any one of those time frames you can make work. They'll all have an S curve on it. The most important is that you're using that S curve entry. So
Cool deal. Well, now we know what to back trade at the back trading session next week, guys. Tony, thank you very much for coming. I think we'll call it a day. The Danes will call it a night, since it's 15 past 9 at home. Thank you very much for coming. This has been very enlightening. And guys, see you out there in Slack.
Thanks, guys.